corporation plans, okay? Most people, they can open a corporation in Canada. Why do they do it? Can anyone on the call tell me, why do people open up a corporation?
To save taxes. That's the main reason.
To save taxes. How do they save taxes? If you open a corporation, how do you save taxes?
Because the corporation tax is 10%, while your personal taxes are minimum 30%. So
exactly. So this is why people open corporations to save on taxes. So some people that might have a corporation, truck drivers, taxi drivers, lawyers, doctors, financial advisors, a lot of people in Canada have corporations. So I'm going to show you how the taxes are actually structured in this case. And I want you to make notes, make a lot of notes, because like I mentioned, if you do one corporation plan, your license, it can pay you close to $20,000. Okay. So I'm gonna share this the screen as well. I'm gonna bring up the whiteboard and I want you to make notes as I go along here. Okay. So let's get into it. There are three ways that you get taxed in Canada. Okay. Now I want you to write this down. The first way is as a employee. Now, when you're an employee, what happens is, I want you to write this down. You make income, you're making income minus taxes, and what you have left over is your expenses. Okay? So all of you know, if you've ever worked a job, your taxes are already taken out of your paycheck. So before your income even hits your bank account, your taxes are already gone. They're gone. Okay? So then you have whatever you have left over, you pay your expenses with that. Okay? Another way, and another way to earn that income and pay those taxes is as a self-employed person. Okay. And here I want to share with you how this works out. You make your income, but you don't pay taxes out of your check. You get 100% of what you earn. Okay. And then what you can do is you can write off a lot of your expenses. Those of you who have a license with WFG, can anyone share with me what are some expenses that you can write off?
a lot of it, Param. Like, for example, if I buy my laptop, if I, get my insurance, what do you call certificate, the fees, which I paid, any examination fees, even pens, markers, anything. I mean,
anything,
lunch,
even your travel expenses,
yeah,
your
lunch,
lunch,
travel, yeah.
all of these things you can write off. Okay. And then what you have left over, that is what you pay tax on. So I'll give you an example. Your income could be 100,000. You had $20,000 of expenses for business. Now your tax is only on $80,000. I would say important to understand. Okay. So one is you're paying tax as an employee. The other is you're paying tax as self-employed. You keep a lot more of your money when you're self-employed. Now, the third structure that people talk about is you open a corporation. And there are a lot of corporations in Canada. Corporation. Okay. And hopefully I spelled it correctly, but let's go over this. Okay. In a corporation, it is a separate entity from you. Okay. This is a corporation. Your income comes into the corporation. Okay. Meaning that your income comes in. Okay. And then you take out your expenses. Once again, you can expense a lot of things: advertising costs, travel, business expense, your rent, your license fee. All of these things are expensed. Whatever is left is paid. That's what you pay taxes on. Remember this. This tax is not an income tax. It's at a corporate rate tax. Corporate rate tax. And like Harman mentioned, it's around 10% only. Whereas your income, you're paying 30%. This is only around 10%. Okay. So income comes in, expenses are taken out, then you pay tax, corporate tax on whatever is left over. Whatever is left after that is called retained earnings. Retained earnings. And you have a couple of options here. You can leave this inside of the corporation and it's not taxed again. Okay? You can use retained earnings to grow your business as well. There are two ways to take out retained earnings. One is you can pull out a salary. Okay? You can pull out a salary and pay yourself. Let's say your expenses are $50,000 this year, you can pull a salary of $50,000. Or you can pull out something called a dividend. Dividend. Okay? And the dividend tax rate is different than the salary tax rate. Okay? You pay less taxes in dividends as well. Okay? Remember this, a salary can be expensed to your corporation, meaning you don't have to pay that corporate tax, you can expense it back. But dividend cannot. Dividend, you will pay the corporate tax rate and the dividend tax rate. The huge benefit here is you don't have to pay a whole lot of taxes if you keep that money inside of your corporation, called retained earnings. You will meet a lot of people that are in construction or taxi drivers or truck drivers. They have corporations. They have maybe 100,000, maybe 200,000, maybe 400,000 in retained earnings, but they don't know how to take it out of their corporation. I'm going to show you today how to do it. So I want you to write this down in your notebook. One, you can make money as an employee. Employees are taxed at the highest rate. Okay, highest rate. Another thing, you can make money as a self-employed. Okay, you get a lot of benefits when you're self-employed. That's why I say, even getting your license and holding it with WFG, just holding your license, there are so many tax benefits that come along with that. And then the third is people open a corporation. And here, like I mentioned, income comes in, expenses out, whatever's left, you pay corporate rate. And then you have a choice. You can, the retained earnings, you can leave it in there, you can pull it as a salary, or you can pull it as a dividend. Okay, so now I'm going to share with you how all of this works. Okay, so I'm going to share with you. Oh, we have a lot more people on. All right, let's go back here. I'm going to go over here. By the way, if you are licensed, I have this for all of you. All our products, everything is in here. We have 5 chapters: financial concepts, all insurance information, investment accounts, returns, and the 5th chapter that I added is taxes and corporation plans. So if I go down here, I'm going to show you. All of you who are licensed can get this. If you're not licensed, you cannot have this, okay? So let's go over here. Here are the tax rates in Canada. Okay, so I'm going to show you the tax rates. These are for, I believe, BC. Okay, and I'm gonna give you a little bit of an idea of how these work. If you're pulling money, these are taxable income brackets. The more you earn, the more you get taxed. 0 to 16,000, you're not paying any taxes. So if you make less than 16,000, there's no income tax over there. But have a look at this: 16,000 to 49,000, you're paying 20% in that's salary, wages, whatever it might be. You're paying 20% on that. But if you pull that money as a dividend, you're only paying 10%, half of that. Okay, so only 10% you're paying there. The next 50,000, which is 50 to the next whatever, sorry, not 50,000. The next, I would say 8,000 is 22%. As a dividend, it's only 13%. 57 to 100,000, you're paying 28%, almost 30%. In a dividend, you're only paying 19%. So how does this break down? I'm going to show you this as well. Okay, I'm going to share my screen here. I'm going to bring it up and I'm going to go to the calculator right over here. Can you see the calculator? Can you give me a thumbs up over here? Okay. We're in British Columbia. So if you pull a salary of $100,000, okay, here's what your tax bill will look like. Okay. Remember, you have to pay CPP as well. Okay. So your total taxes on $100,000 is almost $25,000. A quarter of your income just goes in taxes. Okay. What you're left with is only $75,000. Okay. Now, if you pull the same money, the same $100,000, sorry, 1 second. Let's take this out and we pull it out in dividends. Okay. So $100,000 in dividends. Let's go back to the tax bill. Remember, you were paying close to 25% of your income. Now your tax bill is only $13,000. And instead of keeping $75,000, you keep almost $87,000 in your pocket. This is why so many people open corporations, and this is why a lot of people, they pull money out of their corporations as dividends. Okay, Harman, go ahead. You have a question? Oh, you're muted, Harman. Sorry.
Sorry, what is the difference between eligible and ineligible dividends?
So that your accountant can let you know, but anything over 500,000 can be considered if your income, your corporate income is over 500,000, that could be put into eligible dividends. And ineligible is anything under 500,000. You're never going to pull out under 500,000, well, more than 500,000. So that's why I compare the salary and then the ineligible dividends that you can pull out. But the difference is huge. The difference is day and night. Okay, you can save a lot in taxes this way. So I'm going to go back to our tax rates over here. This is how they work out. Now, here are the corporate tax rates over here. Okay, if you look at British Columbia right over here, the corporate tax rate for under 500,000 is only 11%. Okay, if you go over 500,000, it is more. Of course, okay? But I just want you to keep this in mind. The corporate tax rate is about 11 to 12% in BC. Okay, so I want you to keep that in mind. Now, like I mentioned, income comes in, expenses go out. You pay that corporate tax rate of about 10%. Whatever is left is called retained earnings. Now, here you can pull out two ways. You can pull that retained earnings out as a salary. When you pull it out as a salary, you have to pay CPP and you have to pay other EI, I believe, as well. Okay, so you have to pull out a lot more to keep the same amount. Or you can pull it out as a dividend, which a lot of business owners do. That's what I do. That's what my father does. We pay ourselves in dividends out of our corporation. Okay, you save a lot more in taxes and you can pull out how much ever you need. If your income was, let's say, 500,000, you don't have to pull out 500,000 and pay 500,000 tax. You can just pull out, hey, my expenses are only 100,000. I'll just pull out 100,000 and pay a little bit of tax. And then I can use that retained earnings for something else. Now, here's the problem. People have retained earnings. They don't know how to take that money out or use it without incurring a huge tax bill. This is where life insurance comes in. Okay, this is where insurance can come in and help them. So here are a couple of benefits of owning a universal life or a whole life through a corporation. This is how it works out. There's a policy owner, which will be the corporation. Okay, the insured is the owner of the corporation, whoever owns that corporation. We place an insurance policy. The beneficiary is the corporation. So if something happens to them, the money goes into the corporation and then it goes to the beneficiaries, which is a family through something called a capital dividend account, CDA account. Okay, so it's just the policy is owned by the corporation, is paid by the corporation, the beneficiary is the corporation, but the family also gets the benefit. Okay, so remember, people have money sitting around in their retained earnings. They have no idea what to do with that money. So this provides a couple of benefits. Number one, tax-free growth. If the money is just sitting around, it's not growing. They have $100,000, $200,000 doing nothing, right? What if they could get 5 or 6% on that $200,000 and it's growing? You can provide that. It can help with a buyout agreement. If there's more than one owner on the corporation, if one of them passes away, you don't just get the shares, you have to buy out the shares. Okay? Key person protection. It will help with company growth and succession planning. How do you pass on the corporation to your family? Okay? So this is how it looks like right over here. Okay? So I'm not going to go too much into detail. But first, the policy is assigned by, well, you can take a loan on that money too. So I'll give you an example. If I open up a corporate plan and I dump in, let's say, $50,000, if your cash value is $50,000, can you use that money? Can you take a loan against the cash value? Yes, you can. Now, the great thing is there's no taxes on loans. Okay, so if your loan percentage, let's say your interest rate is 6%, you borrowed that $50,000 at 6%, and your corporation, whatever the money sitting in there is growing at 6%, that's a net benefit. You're not paying anything and you can use that money. Now, when this person passes away, the death benefit is paid out and it cancels out the loan. It pays off the loan. And whatever is remaining goes to the family. This is a strategy that a lot of wealthy people use to take money out of their corporation and save taxes and not use it when they're dead. They can use their money when they're alive. Okay, a couple of other things. This is another thing I wanted to share over here. This is just an example. This client is saving $2,000 a month into a corporation plan, which easily people can. I've done many plans where there's $500 a month, $1,000 a month, $2,000 a month that they're putting in. Okay, have a look at this. This is they're only paying into this for 20 years. Okay, this is their cash value growing, and this is their estate benefit. Their life insurance is growing as they go along. Have a look at this. Total they put in is $500,000. Okay, they have a net benefit. They have a cash value of $750,000 that they can use for retirement. They can start pulling money out of this corporate plan, and they can use this money for retirement to fund their retirement. Okay. Plus, they have a $1.6 million tax-free life insurance benefit that goes to their corporation and to their family through CDA account. Okay. So this is just another way to circumvent the taxation, and it will build the family's wealth. Okay, that's why I believe everybody that has a corporation should have a corporate plan as well. Now, if you do a plan like this, and let's say the corporate, let's say they're putting in $2,000 a month. Okay, I'm gonna show you what that looks like. If they're putting in $2,000 a month times 12 times 1.5, that equals 36,000 points. Okay, if you do this as an associate level, 36,000 points times 36%, you made $13,000 doing one of these. If you're a marketing director, you made $18,000 doing one of these. One plan. Okay, I've done it, and I've been paid over $20,000 for one of these plans. Okay, that's why I wanted to share with everyone in Canada, we get taxed the highest in the world. We are among the highest tax countries in the world. You can get taxed three ways. One is as an employee, the other as a self-employed, the other as a corporation. Most people end up opening a corporation. They have retained earnings. They don't know how to take that money out of retained earnings without paying a massive tax bill. We have a strategy. We can help them to do this. Okay. All of you who are licensed can actually help people to do this. So I want Juliana to close this call out, and she's going to give you some questions that you can ask business owners. I want you to write these down. They're really, really important. So Juliana, go ahead, take the floor.
Good evening, everyone. And since we have a great topic today about the corporation, I actually have a corporation as well. And the main reason why I open a corporation and register myself is incorporated because of the tax purpose, right? And also I wanna secure my asset as well. So when I sit down with client and some questions that I can ask on the corporation side, remember this: the strategy we show you today, it's either for people who have corporation. If they don't have a corporation, they can still have the coverage. They can still have another strategies, right? Not only for corporations owners, but mainly if, let's say, they have a corporation, then obviously they should use this strategy. And some questions that I ask, there's not many questions to ask. Someone who have a corporation, they already know what is the problem. So what is the problem? And we have a solution for that. And question number one, you can ask, how much retained earning do you have in your corporation? Meaning how much money stuck in your corporation, so you would like to take it out without paying taxes, right? Question number two, is your corporation will be asset or liability to your family? So I can repeat question one, how much retained earning do you have in your corporation? And question number two, is your corporation will be an asset or liability to your family? Meaning your family, when they get your business, if you die as a business owner, how much taxes they have to pay on the business, right? So the person on another end will answer those questions probably in their mind. I have no idea. I never ask those questions. I should talk to my tax accountant or tax lawyer or so on. Okay. Question number three. Do you know the strategy how to pass your asset from your corporation through capital dividend account to your family tax free? Do you know the strategy? How to pass your assets from your corporation through capital dividend account to your family tax-free. CDA account, yeah. So any corporate owner or business owner, they will probably question themselves first. Okay, this is a really good question. I never ask myself. I should probably get more information from my tax accountant. And you should say yes, you should, from tax accountant or tax lawyer. But there's a strategies that your tax accountant might not know about, and I want to say that with a confidence, because even the previous my tax accountant didn't know about the strategies that we were teaching you guys about using life insurance as a strategy to pay less taxes or avoid paying taxes now. So a lot of tax accountants don't know about this strategy, again, because they just know information based on the taxes and so on, not regarding any thing about insurance and so on. That's why they might not be aware. So don't be surprised that your tax accountant doesn't know about, right? So also that's a financial advisor job to explain all of this. And with that, I want to actually go back to you, Parm.
All right, thank you so much. I think that's what we wanted to really share with you today. That I want you to keep in mind, we are one of the highest tax countries in the world, and people are always looking for a way to save on taxes. Okay, so if you can show them a strategy like this, remember it's just about value. There are people that put in $50,000 a year into plans like these, and someone is doing it. Okay, so if you understand it and you're able to explain it to people and show them the benefit for their corporation and their family, there's no doubt in my mind every corporation owner should have a corporate plan, no matter how big or how small. Okay, and you're going to be able to do this. Okay, so I hope you guys all learned something today about taxes. I think that's it for today's call, and you got some type of value as well. Okay, so good night, everyone. I will see you guys all next time.
Param,